How's it going? Happy Friday. This is Aaron Price, CEO of Tech United New Jersey. Excited for another live show today. Going deep into tax planning, QSBS, how to plan for an exit. With me, Dan Krolikowski, a partner at Withum. Dan, good to see you. Thanks for joining us.
Aaron, great to see you too. Thanks for having me. Looking forward to talking.
Where are you joining from today?
I'm actually joining from New Jersey, from Princeton, New Jersey.
Where in New Jersey?
Princeton, New Jersey, where we're headquartered.
Excellent. Well, appreciate you jumping in. What's your role at Withum so people understand some of your expertise?
Yeah, absolutely, Aaron. So I'm a team leader of what we call Withum's Founders and Tech Executive Group. So used to working closely with founders, early employees, executives in general, in dealing with their personal tax situation, tax planning, you name it, can kind of help in all different areas.
Awesome. So one thing that's been on our mind is the issue of qualified small business stock, commonly known as QSBS. As you know, the federal government recognizes this tax incentive. 45 states around the country recognize it in some capacity. New Jersey currently doesn't. We Tech United New Jersey, working very hard to try to change that. So let's talk a little bit about what this is and how founders, both in and out of New Jersey, can take advantage of this policy. Can you explain what it is, and then we'll talk about some of the benefits?
Yeah, definitely. So high level, Section 1202 allows for an exclusion on the sale of qualified small business stock, also known as founder shares, also known as QSBS. And basically you can exclude, if you sell qualified small business stock, you can exclude either the greater of $10 million per company or 10 times your basis in that company per company. There are a lot of, rules within that code section. A lot of the rules and requirements, are maintained at the company level. For example, it's got to be a U.S. domestic C corporation. The stock, the company has to have less than 50 million assets at the time you acquire the stock. The company has to be in a qualified trader business. So, most tech, SaaS companies, you name it, will qualify for this benefit. And there are some other, entity level requirements. And then there's some individual requirements where, you basically have to hold the stock, get the stock at original issuance from the domestic C corporation and hold it for 5 years. But it can be a great benefit for individual owners of that qualified small business stock.
What are some things that you have seen investors or possibly founders screw up in, disqualifying themselves from this? What are some common mistakes people make?
Yeah, so, great question. I always say you can never get started planning early enough, for qualified small business stock, if that's a target for you. When you get founder shares, they're generally restricted, which means you don't actually own them till they vest, till the restrictions lapse. There's, under the tax code, something that's called an 83B election that allows you to treat the grant of restricted shares as actually being vested on the grant date. That, enables you to pay tax on the value of those shares on grant, but also lets you start your holding period sooner. So you have to hold qualified small business stock for 5 years. So there can be other, I'll say, issues with missing an 83B election. However, one of the biggest ones could be not starting your holding period in the qualified small business stock till it vests. So, that is one pitfall, Aaron, that, we generally see. There's some other stuff as well, in terms of if you have stock options or, if you have convertible debt. So depending on, what your actual investment is in the company, there may be different things to think about.
Do options qualify?
Options generally don't qualify when they're granted to you or vest. You actually have to exercise the option in order to receive the qualified small business stock. In addition, if you have convertible debt, then that note actually has to convert and you have to hold the shares, before you're counted as having qualified small business stock.
On the options piece, can that happen simultaneously? Can you exercise and then go for the benefit right away? Like, is it a technicality, or do you have to hold them then for the 5-year period?
Once you exercise, you still have to hold it for the 5-year period. There can be, depending on the size of the company, if it's still considered a qualified small business stock on exercise, a way to stack impact the exemption amount. So thinking about the 10 times basis, if you have stock that you've held for 5 years and you have over a $10 million gain and you exercise options, while the company's still a qualified small business stock, even in the year of sale. And if you think about it, in order to get the 10 times basis, you have to pay over $1 million. So we're talking about a big number. You may be able to, exercise in the year of before a transaction happens, and then, be able to pack and get larger than a $10 million exemption. So a strategy you don't see a lot. Generally, we would say, hey, think about exercising as early as possible when the value of the company is low. There's obviously some risk associated with that, but there are other opportunities in terms of the options if they're not exercised, early.
And this is an incentive for both, stockholders operating inside the company as well as investors and funds who invest in the company, correct?
Another great question. Yeah. So, the only, real qualified holder of qualified small business stock is a C corporation. So an individual, an estate, a trust, a partnership, and S corporation can all be holders of qualified small business stock. And if it's a pass-through entity like a partnership or an S corp, that benefit will flow through to the partner shareholders of that entity, generally.
and the LPs of that fund, correct?
Correct.
Yeah. Do you recommend to founders early on to set up trusts to hold their stock?
Yeah. So it really depends on, what the intent, of setting up the trust is and where the benefit is. There is a difference in planning for estate taxes versus income taxes. So generally, if you're planning for estate taxes, you'd want to make, gifts or transfers, as soon as possible while the value's low. If you're, looking for asset protection or doing income tax planning, sometimes you don't need to transfer it as early. So I'd really say generally it's better to think about it the earlier the better. But at the same time, every situation is different. So you got to look at it differently and plan for it differently.
And let's say there are folks watching who perhaps didn't set this up correctly, but they still think they're 5+ years out from an exit. Can you fix this?
Absolutely. 9 times out of 10, depending on the situation, there's ways that, you can plan for this and fix it. Generally, the only time that, you really can't do anything is if the company's already over $50 million and not considered a qualified small business stock anymore.
Over 50 million in assets, right?
Correct.
Okay. Are all states created equal? How are different states treated?
Yeah. So, you kind of talked about in the opener too. This is really a federal tax benefit. And every state, basically decides, are they going to follow this benefit or not? So most of the states, in the United States, do follow the federal benefit, but some states don't. For example, New Jersey, California, don't follow the federal benefit. Some states like Massachusetts recently, they used to have a smaller tax benefit than the federal benefit. You had to be located in Massachusetts. However, now they follow the full federal benefit. So it seems like more and more states have continued to adopt this benefit.
And by the way, just to be clear, if someone lives in New Jersey and works or invests in other states, in particular New York, since that tends to be the market, can they? What happens to them in a situation where they might have some sort of liquidation?
Yeah, great question. Usually, high level, if you have compensation, that income is sourced to where it's earned. So if you're, working in New York and you get paid a salary, you generally pay tax in New York where you work, and you would get a credit where you live. So if that's New Jersey, you would get a credit in New Jersey for the New York taxes you paid. On a sale of stock, it's a little bit different. You have capital gain income, and that's sourced to where you're a resident of, what state you live in at the time of the sale. So if you live in New Jersey and you sold qualified small business stock, you could qualify for the federal exemption. However, you'd pay tax in New Jersey on that sale, on the gain.
So that's a good, the way the bill is currently written, we're looking to amend it in New Jersey to make that not necessarily the case, so we can make sure that founders here can stay here, even if their businesses or operators here, even if their businesses or their activities are happening elsewhere. Same thing with investors, where we've heard directly investors, like a young principal who's moving up the ranks, growing their family, looking to move. We're not getting those people in New Jersey because they recognize that it's just too, there's an extra bill for specifically the line of work that they're in. So hopefully we'll have some changes soon. Let's talk about the Tax Credit and Jobs Act. And so how is that affecting, is that sunsetting? What do people need to know about this issue? What can they do to change course?
Yeah, great question, Aaron. So, right now, we obviously know there's an election coming up, and in the current Tax Cut and Job Act that Trump implemented in 2018, basically a lot of these provisions sunset or basically go away after 2025 and either revert to, the form before that, or, we'll see, there's probably going to be some new tax law change. So certain things like the qualified business income deduction, which makes pass-through entities tax a little bit, lower and more comparable to the C Corp rate. That's supposed to go up a lot. And one of the biggest thing that's going to happen is the federal estate tax exemption, which is about $13 million a person, is supposed to sunset to $5 million a person. So we're getting a lot of questions about, how do I plan for this? How do I think about this? Do I need to, make decisions now? In the history of the exemption, it's actually never really went down. It generally went up. So it'll be interesting to see what happens. But right now it is sort of a use it or lose it exemption. And the IRS has come out and said, hey, if you use the full $13 million exemption and it gets reduced to say 5 million index for inflation, we're not going to have any clawback. So you'll still be in the clear of utilizing that. So there is sort of a window here to do some planning. Specifically for New Jersey, Aaron, there is no estate tax, right? So it's not necessarily a New Jersey specific issue, more of a federal issue.
And in New York?
New York does have an estate tax. So, right now that is a lower amount. It's not the full 13 million. It's about half of that. So, anybody that is, living in New York probably, may want to just think about that in general and in other states in the tri-state area.
I know that, officially you need to give out this advice. You have no crystal ball. Is there chatter that people believe that this will be renewed no matter who wins the election, or do you believe it actually might really sunset?
It could go either way. Generally, this has been a point that, everybody can agree on, and it's generally went up. However, generally, Democrats want to redistribute the wealth. Republicans want to, conserve their wealth. So it could be that, this is something that's in play to stay lower.
Let's talk about the angel tax credit. So again, another incentive all of these, to be clear, especially for folks who may not be aware of what these are about, it's not necessarily about tax breaks. It's more about reducing the risk of investing in early stage businesses. So whether you're a founder that's putting up an enormous amount of risk to build something that on average takes 8 to 10 years to see a major liquidity event, or if you're an investor with that same profile, where basically 1 in 10 investments has to make up for the 9 losers or the singles and doubles or losses. These programs, both Angel Tax Credit, QSBS, are meant to just help decrease some of that risk. So I just want to make sure we're clear on that as the goal. That's what the government's actually trying to do here, is because they're so incredibly risky. On Angel Tax Credit, can you explain what it is now? And then I can share also, other policy issues that we're working on to try to change that.
Yeah, absolutely. And I think the other thing, Aaron, is that, generally the U.S. government and a lot of the states' government want to spur innovation, right? Right now, we're not only competing, with each other in different states in the country, but we're also competing on a global level, right? So I think we want to make sure that, we all stay kind of, on par, with everybody else in the world. Specifically, the New Jersey Angel Investor Credit, it basically gives you a 20% credit in a qualified investment that's made into a New Jersey technology company. There are, some restrictions in that there has to be less than 225 employees. There has to be offices in New Jersey, things like that. But it's a great benefit for people, that invest in New Jersey-based companies.
So to be clear on this one, if you live in Arkansas and you spend you invest $100,000 on, Dan's new company, the state will send you a check for 20 to 25%, depending on how his business qualifies. But just send you a check directly. You don't have to be a New Jersey resident to get this benefit. However, it turns out if you look around the country, the average angel tax credit is 34%. It goes as high as 60% in Maine, where they're really trying to, up their game. And so we have now a bill in play to jump this to 35% with a 5% bonus for women and minority-founded businesses, so that it could be, basically between 35 and 40%. That same $100,000 example would then yield a $35,000 to $40,000 check back to the investor, again, to help decrease that risk. And for professionalized angels, they typically have a portion of their portfolio that they say, okay, I'm going to invest whatever, $100,000 in as angel investor this year. And so this just, in our view, gives them a chance to put more money to work. It's not about putting more money necessarily in their pocket. It's about being able to invest in more businesses, and therefore, hopefully, we have more early stage growth, which New Jersey desperately needs. Have you seen this motivate investors? Do you have clients who see this and they're on the fence, or they look for states where these incentives are higher?
Yeah, absolutely, Aaron. Have a lot of clients that have taken this credit, right? And I also think it's a way for, New Jersey-based companies to, market to investors, right? And say, hey, there's an extra benefit, whether it's, could be qualified small business stock, whether, it's this is up there for New Jersey-based companies. So yeah, have seen a lot of investments in this and a lot of benefit. I did want to point out too, Aaron, that there are not really pitfalls, but just kind of things to consider with this credit as well. Anybody that invests in a New Jersey-based company, like you said, can get the benefit, but there is a time limit in terms of, the company has to submit an application, the investors have to submit an application within 6 months. And then there's also a dollar limit where I think New Jersey sets aside a certain amount, every single year. So just want to make sure that companies, investors are aware of that, and may probably qualify for the benefit. It may not even know, right? So it's important that this administrative stuff, kind of happens timely. But I think it could be a great benefit for companies that want to market to investors, in the state or outside the state.
Yeah, absolutely. There is a benefit per investment. In New Jersey, there's a $35 million allocation of budget for this program in the state. What we think is particularly noteworthy is that last year the state only issued $8 million in these credits. So we don't think that currently the incentive is strong enough to be maximizing that pool, nor do we think there's enough early stage companies. So we're hoping both of these things will start to change. But it's a sort of like, if you walk down Main Street and everybody's got a coupon for 34% off and yours is for 20% off, it sounds great until you realize everybody else is doing that. And you talked about being on par with everyone. And to be fair, we are getting a lot of support from the state. The EDA and the governor's office are supportive of this change. And so there's now it's going through the legislative process. So I think it will happen. But we want to make sure that we're as competitive as the next guy, and hopefully even more so. I also had a board member talk about pass-through losses and carrying over losses, which New Jersey does not allow. But can you touch on that issue?
Yeah, absolutely. So New Jersey historically did not allow business losses to carry forward. Now, they basically upped it from 0 up to 50%, but it's not generally just, hey, you could take 50% of your losses. You have to calculate what they call the business increment percentage and apply that. So you basically look at the income that you earn that year from a business. You look at, the net income or loss from the business, and you calculate, hey, you could take 50% of that difference. So it's better than nothing. The other thing, Aaron, is that New Jersey does not allow capital losses. So if you sell stock at a gain, a net gain, you sell multiple stocks, you have to pay tax on that. If you sell, stocks at a net loss, for federal purposes, in a lot of states, you can carry that forward. For New Jersey, you basically lose that loss. So what a lot of, investors will do is set up a partnership, maybe with their spouse, for example. And if there's, net capital losses, that can carry forward in New Jersey as a business loss. And theoretically, you can get 50% of that at some time in the future, right? So it's something where it's better than nothing. But New Jersey historically does not allow those loss carry forwards.
Yeah. So there's, these are dense, complicated topics. People should have professional help. Is this the sort of work, just to be clear, that you and your team do it with them, and how can people get in touch with you?
Appreciate you asking that, Aaron. Absolutely. This is stuff that we do every day. We can assist clients from, just doing regular tax compliance, right? Doing tax returns, things like that. But where we can really add value is helping clients plan for, just whatever that is: income taxes, estate taxes, charitable planning, estate and trust planning, you name it. We're actually a national firm, so can do that from a federal perspective, from a New Jersey perspective, but really can do that from any kind of local perspective.
Awesome. Well, I really appreciate the time, the advice. Withum has been an outstanding partner to Tech United New Jersey for a very long time. Ed O'Connell, one of your partners, sits on our board and has been fantastic help. And we've hosted the board meetings and things at your space. So we really appreciate everything that Withum does in the New Jersey community and the expertise that you shared here today. Because we work with a lot of early stage companies, but without this kind of long-term planning, it can be very, very expensive, or it might be harder to raise capital because you're not using, explaining the right incentives to investors and employees. So make sure you reach out to Dan, plan appropriately, do it way in advance, so that you can maximize the outcome on these high risk ventures. Dan, really appreciate the time today. We tend to end with the high five. So on the count of three, give me the high five on the camera. 1, 2, 3. Boom. Good to see you.
Thanks for having me, Aaron. Always great chatting with you.
You too. Thanks a lot.